Okay, I'm showing my screen. Welcome everybody to today's presentation. I want to talk about option trading success and what it entails and what needs to be done to move forward with it. Because there's options have a lot of opportunities, but we need to know how to handle them right. And is that the only thing we do? No, definitely not. We also trade stocks, futures, and forex. But today I want to focus mainly on options for stocks. Yeah. And with that said, so here a little legal disclaimer. We are concept developers, trading and investing educators. We are not broker dealers. And let us go a little bit into the history of Never Lost Trading, where the name comes from, what we did. At the beginning, we were starting out with basically hotel meetings. This here is from 2009 in the Caesars Palace in Las Vegas. But we recognize pretty quick one-on-one training sessions is helping people to be successful traders. Why? Over the years that we are in business, and there's many, we recognized there was not one and the same person with the same risk tolerance, amount of time that they can spend for trading, affinity to certain of the products. And if you mingle them all together, you give a mix of interpretations that don't do justice to the person, that don't make you necessarily a trader. But that's what we do. We teach you one-on-one, so you get our concepts tailor-made to your time associated, to your focus that you can do if you're, for example, trading an IRA or even a 401k, or if you are a futures trader or an option trader, we tailor everything to you. Yeah. And so we are more than 10 years in business. In one-on-one, only about 2 years we did the hotel meetings, and we focus on algorithms and concepts to follow institutional money moves. That's our edge. And where's the edge? I'll show you in details of how our algorithms paint high probability opportunities. And the name Never Lost Trading is not a promise that you never lose a trade. It comes from the idea never stop loss trading, because instead of taking the stop, we try to repair the trade if that is possible. And I show you in respect in particular to options why that is a very, very essential tool that moves you ahead. Yeah. So today's focus, as said, option trading, and we're going to look at option versus stocks. Where is the edge and the opportunity for you? We are predicting potential price moves. We look at the system base, what a system shall all give you, so that you can trade as mechanical as possible. That's very, very, very essential. Yeah. So don't leave much up to interpretation. You'll need a mechanical based system. If it's ours or somebody else's, it needs to be as mechanical. Buy at this point, sell at that point. Here's your stop or adjustment level. Very simple. And you need a knowledge base, because coming into an area like the financial markets, it needs a knowledge base so that you know in which transactions you can participate with a better edge or with a worse edge. And if the edge is not good for you, don't do it. Yeah. And time management. So how much time do you want to associate to a trade? How long does a signal last? Because you want to take profits. That's the name of the game, or end the trade, or repair it if it's repairable. And so this and a lot of more I put together here in a presentation, and I want to guide you in predicting price moves. If you make a prediction about something, you say what you think will happen. Yeah, so you're looking into the future, and here we're looking at a price development. So we need a pre-stage of a price move, identify it, and from that pre-stage, we're going to portray it out into the future. And how do we do it in our system? We call it a Never Lost Trading NLT SPU, speed unit. So we say in a certain period of time, price is supposed to make that price move. To make that a little more visible, I say, okay, you have an entry price. Yeah. And from the entry price, you move forward and you have what? An exit price. Yeah. And in between, price is going to wiggle. So therefore, I draw you a fuzzy line. And there's two components to it. One is time. In a certain period when there was a signal, your price move shall be concluded, or you are wrong, or you need to stop being in a trade. And that price move, yeah, from entry to exit, you measure, and that's what we call a SPU. So our systems spit those out. They tell you at every moment a SPU, speed unit at that price movement is this or this, and you can trail and go back and change We set up all the charts for our clients, yeah? And also there is a stop or adjustment level. Why adjust? Never stop loss trading. We come from adjusting trades. We try to repair things if they go wrong. Why do they even go wrong? Because we work on a probability. We have high probability trade setups, but those that go wrong, we want to have the least damage from. Because one thing traders often face that are not that experienced, small win, big loss, and we try to prevent that is not going to happen to our clients. Yeah, and so the attractivity of options versus stocks. Let's put it together in a very simple terms. The very first and the highest is return. If a stock moves on a daily chart in average 2%, the option trade, depending of which delta you pick, can give you a 20% return, a 50% return, or a 70% return. Let's put that again in perspective. If a stock moves 2%, you make a 2% return on cash. If you trade the option, you have the opportunity to make 20, 50, 70 or more percent return. So that is very, very attractive. It sure comes also with an associated risk, but we can do risk limiting strategies, and do trading options helps you to trade for a fraction of the price. What does it mean? Yeah, we have a much lower investment, higher returns, and we can limit our risks. So I'll put some delta. For those of you who never dealt with options, the delta tells you when the underlying stock, let's say Facebook, moves $1, the delta says then the option price change here, if it's 0.99, 99%, so that's 99 cents that it moves. If the option delta is 30, the underlying stock moves $1, then the option price changes by 30 cents. But look here, the cool thing comes in when you see how much do I have to pay to participate, and that's in particular for when you see big stocks, yeah, like Amazon or so. Yeah, so you pay 10% to participate in a delta 99, 3.5% in the delta 70, 1.8% in average on a delta 50, and about a 1% or 0.9, I put it out here, in a delta 30. So that's very little investment. And then we look at the extrinsic value or time value. Yeah, when you get at the money, yeah, delta 50, or out of the money, it's 100%. That's all for time decay. If you have it at a delta 99, you only have a 1% time decay. So which one is the right one to have? Let's do some examples and put things here in perspective. Yeah. Here, oops, yeah, so I have here an example for Facebook. Yeah, so you see here on Facebook, a $200 stock, give or take. When you do a delta 99, you pay $20 per share control. One contract controls 100 shares. So you have a $2,000 investment. And if your expected return on this one is 20%, yeah, so then you make $400. So again, look, if you bought stock, yeah, for $2,000, 200 is one, it's 10 stock. If it moves $4, you make $40, here you make 400. So that's a considerable difference. So that's the sexiness to option trading, because you can have much higher returns and can put things in perspective for very low entry fees. See at the delta 30, you're in for $180 for one contract, and you're supposed to make 126, so that's a very nice relation. However, that's not solving the option trading game from the get-go, because every reward has to be associated with a risk. So let us do that now and associate risk and reward. Say, okay, what can we expect on a one spool price move? That comes from our system. The system tells, okay, on this. So you see we have relative similar relation, one-on-one. You have a 20% chance on a delta 99 and a 20% risk, while here on a delta 70 you have a 30% chance and a 70% risk, and so on. And so when we calculate this on the basis of 65% and 55%, most of you are going to be here, yeah, because very few trading systems give you consistent high probability trade setups. And so you see, there's only two strategies here, that gives you a kind of an edge to make your money, yeah? So give you a 7% average return or 2, but there's also some variability in it, and that shows you here, there might be attractive to be slightly out of the money and trade options because you have relative higher returns. However, you'll need to deal that right to solve the option trading puzzle. And I want to add to that and help you what all is needed. Here I put 7 variables together saying, okay, if you want to be a good trader, and look, this counts for stock trading, futures trading as well, but here with options, you need a couple of more parameters to control because you have an asset that's decaying over time. Yeah, and so you need a price move indication. You want to work at strong price moves. You need to have a valid option chain, your trade repairability, the max premium to pay. Your system needs to tell you the strike price to select. Your system, or I need to tell you time to expiration. So what do you choose? Very short term, 3 days, 4 days, 12 days, 42 days. There's always a rhyme and reason for that. And option trading strategies. Which one am I take? Do I buy a put or a call for going long or short? Do I do a credit spread or do I do a debit spread? I enlighten you with all of that in the continuation of the presentation. So first of all, I show you system-based. So you see, wow, what are the charts doing? It's a little narrow focused. You see here a daily chart for Facebook, and you see what the system's going to give you bar by bar. And here it's at the instance where you have a buy signal. So buy above 209.79. So that means next day we'll trade Facebook only under the consideration if the price of that candle ticks higher, and you see it does, or did. It opened here, bang, it ticked it out, so we are in a trade. We formulate a target, yeah, so which is here at the dot, and here we have a very strong setup, yeah, it's called a change in command setup. Buyers take over from sellers and push to the upside, but it's not going to go forever. We tame our hunger for making returns by always having a clear-cut indication of where the one spool price move is and where our exit price move is. And also it tells you one thing here, that signal lasts for about, lasts for 5 bars. And in those 5 bars, it's supposed to be at target. All you need to see if you adjust the trade or what you do to it. Yeah, very important in that constellation. And the system spits out, that's my spool, $3.53, 1.7 return on cash in an uptrending market. And he was my target price here, so you can absolutely put it in. So at the moment you are filled with your order, you can put your target, there's your stop or adjustment level, and the relation between risk and reward was favorable, kind of one-to-one. And so with that, you had a good trade to go forward. Does it only work for Facebook? Absolutely not. It works for every instance. Here, and a client, his name is Jeff, he wrote me that was his Christmas present because on December 23, the system gave him on GDX, gold minus, yeah, that's an ETF, a buy signal, yeah? Buy threshold, buy me above this, and it happened. So he bought into that with call options. And that day, he got another confirming signal, said, okay, ambiguity is over, that's our purple signal, it's going to be strong. And we have a combination, you see that cyan dot here, it's called the light tower. What starts in a light tower likes to end in a light tower. So that sequence he traded, and he did for a 418% return on the capital he invested. So that was his Christmas present, because you see here by 12:31 he was out of it. So that was a nice little benefit, following the system, following clear-cut price thresholds and indications of how to move in the market and how to move forward. We give you more of those examples, but I want to refer here, why does such a thing work? Yeah, we put a lot of math behind it, yeah, so that's where we are specialists in it. But however, why does it work? Because we are following institutional money moves. More than 85% of all transactions are institutional based. And with that, they leave a trace. Yeah, so we find something with our way of math in the supply and demand change on the level 2, where we say, okay, there's a pre-stage, but it has to be confirmed. Yeah, so that's the important point with our threshold. And with that, we can put a conditional order out there. And you will see we specify in advance the max price we want to pay for an option. So a conditional order goes above $205.11, we want to buy an option for $1.25 of this specific. If these things come together, we have a trade. If they don't come together, we just walk away from it. But we usually have more trades than we have money as private investors. Yeah, and the potential price move, when it's confirmed, we go with it. And the edge, where's the edge? We are faster in and out of a position because we don't hold that much. Yeah, we can go in and out of positions very, very, very quick. But there's knowledge which you need to have to work on this. Yeah, and the knowledge here you see on the chart: where to buy, where to sell, and I can also make the examples on the way to the downside, but you always have clear-cut entry decisions. Yeah, so buy above 70.33, clear-cut targets. Yeah, the one SPU move that I showed you here, and a defined stop that's down there. Yeah, so you see that crossbar, and there you either adjust the trade or you get out. And in the relation of risk to reward, you puzzle together of how your position size is. Don't always put the same position in the market. Make the position dependent on the signal strengths, the price that you have to pay, and those parameters together, we put surely for our clients into Excel spreadsheets where you have a hint of what the position sizing shall be. Yeah, very essential. All of these elements, whatever you decide for, they need to be in your portfolio as a trader to be successful, because when you start to guess and interpret, you make yourself fail over time. Yeah, so here's a chart for crude oil. He said, wow, we talk about stock options today. What's it to do with crude oil? Look, for crude oil, there's derivatives that you can trade that follow exactly that curve, exactly that price curve. And crude oil, just as a hint, crude oil makes weekly decisions. Why is that? Every week we make crude oil stats around the world. What's in stock? What is our demand level? And with that, the investment firms go and buy or sell. And our system is going to tell you, see here, sell 72 or 90. Yep, there is a buying point. There's a reversal point. Does it only work in the past? Absolutely not. Let us jointly go just in the most recent days. Yeah. So you saw here, weekly chart, December 6th, we had a buy signal. Yeah, Nevelos Trading Power Tower, that's out of top line. It has a $4.05 SPU at the entry. It is SPU target and stop are on the chart, so we knew we're going to be here. And we had a reach of about 5 weeks. But at week number 1, 2, 3, 4, target was hit. Yeah, you saw here, target was hit. So what did we do? We left the trade. Had we not left the trade, yeah, did we not leave the trade at that point in time, it would be bad, because you know those little minuscule things here between 64 and 61.50. There's a $2,500 a contract, but again, you can trade those happenings with derivatives with increments of $50, and that brings you in a trade, even so if you might not want to do at the very beginning such a high risk. Because trust me, risk and reward in trading, they somehow go hand in hand. But you have an edge as more you have a high probability system, because you know if you're more in it and you do the right things, and now you see with very little fractions, if you can do that trade with $50 of risk, there's a different way of dealing with that. Yeah, and so therefore on the relative importance of all those factors that I put together here, let's put a check mark on the price move indication. I showed you Nevelos Trading top line. And now let's look what's a valid option chain. Yeah, very important. So you see a lot of knowledge base is needed, and we're going to differentiate in those variables between knowledge base and system base and where those come from. So now option chain. Let's trade stock options for a minimum price move of the underlying, so of the stock of 70 cents. Take that for lots of years of experience. I did my first option trade in 1983. And so if you trade below, slippage will rip you apart. And I give you an example. Yeah, because you want to have a particular narrow bid-ask spread, and you want to have an open interest on that particular strike price that you're buying. For example, if you buy a put or a call, and you want to have a volume, yeah, daily transaction of at least 100 on this, because else it gets complicated. There's some they have 11 million, they are super duper, but there's some other options that are a little more narrow, and you need to find your way through. Let's do a narrow bid-ask spread option trading example. So if the stock price moves $1, yeah, and the call price, so we trade to the upside, at entry is 50 cents. So the bid ask might be 30 to 50. So what's that? Yeah, it's always what you don't want. You want to sell at 50 and buy at 30, but that's not how it's happened. Yeah, you can sell at 30 and you can buy at 50. That's what it is. So we buy at 50, and also we associate, you saw on the prior table, a 70% risk in such a trade, and we trade for a 70% reward. So our risk is 35 cents per share times the contracts, one contract holding 100 shares, yeah, or controlling, yeah. So now we see winning the trade, yeah. So what's going to happen? The stock moves up $1, super duper, we were right. The bid-ask spread is 50 cents to 70 cents. So now we want to sell, and let's assume in that range we can make between 0 and 20 cents. So if we could sell at 70, which most likely is not the case, we would make 20 cents. So that's nice. Over 50 cents would be a 40% return. But let's assume we are selling at 60, the mid price between those. So we're making 10%, 10 cents, not percent, 10 cents at that point in time. Yeah. So, but now let's see, if we win 2 out of 3, we're negative. Yeah. So 35 cents was your risk, 15 was your risk. 10 cents you make, 2 times 10, 20 minus 35 minus 15 cents. So this is very important that you look at what type of a narrow bid-ask spread option chain you have, because if you select the wrong one, you lose on always by having the difference between bid and ask ripping you apart over time. And that's a learning exercise. We categorize all in our reports. We categorize all options in red. They're super duper. Green, they're very acceptable. Orange, potential, and white, don't trade them. Yeah. Why do we even list them? Because we have lists for stock traders and such. They want to trade the stock, and some. Let me give you an example. American Express, AXP, if you trade it, it has exchanges 4 million shares a day. Super good for stock trade. But it exchanges about 100 option contracts per day in each of the different expiration days. So that's very little. Yeah. So with that, you want to stay away from some, or you want to price them differently. Yeah. So now trade repairability. Why is that so important? I give you a calculation with no repair and with a repair on an ideal world. Yeah. So if you have 70% win, 70% loss of the investment you put into the option, and you have 2 cents slippage, yeah, and we have a dollar price move as we had it, yeah, or the option price is $1. So you see here, if you win, you make 68 cents. If you lose 72 because of the slippage, yeah, the bid-ask spread difference. And if you win 2 out of 3, which we encourage you to have a system that gives you that, you make 64 cents. Super duper, nice return, 64% return over what you put into. Yeah, with a 50% reduced loss, if you use a trade repair ability, you only lose 36 cents when you lose. So, okay. What do I make when I do my gain? Same thing, 68 cents. If you win 2 out of 3, 2 times 68 is $1.36. Minus 36 cents is $1 per share controlled. Yeah. Yeah, so one contract controls 100 shares, so however many you put out forward for that. That's a 56% higher return. And you have to see on the loss over here, sometimes when the stock price moves rapidly against you, the loss might be more than 70 average. And so with that, you need the repairability and understand of how a repair of an option trade can be done to be in the game. These are all prerequisites I want you to consider within trading. And it's not complicated. It can be learned, but it's not easy. It's not written everywhere on the wall. So you'll have to find somebody, and that's what I'm here for today, to show you how that all is done and how that can help you. Yeah. So if I now put together, so the strike price, the max premium to pay, and the time to be in a trade, yeah, because we work with something that has a time decay. So we can see the following: time to expiration. An option with extrinsic value or options with extrinsic value have the highest decay in the week of expiration. Easy. Hence, you want to have enough time so that you reach your target prior to the week of expiration. Example, if you assume you come to target from a weekly chart, so you say in the 4 weeks should be on target, so you have to buy another week. Yeah, big hint, take a note on this, yeah, because then you are not constantly under pressure. And so we favor 50 cents, $1, $2.50 strikes over 5. It depends also on the time to expiration, which one you take. And so typical $2.50 strikes is Amazon, Netflix, Apple. Then you have the dollar strikes, Nike, IBM, Baidu, or 50-cent strike, yeah, Starbucks, Cisco, Gold, all nicely tradable. And here I have one of our alerts put up here where you have a relation between the price and the time. Yeah, so we had Boeing aircraft, ConocoPhillips, AppTV, yeah, that's the prior Delphi, and Emu. So to tell you, look, the first two are green, they have a good option chain. The other twos are potential option chain, but when we looked at AppTV, they had like bid-ask spread between 40 to $1.40. Why is it on the list? People might have bought into the option, but anyhow, direction wasn't confirmed. Yeah. So here we put out an entry price. Only if that price is reached, we are in the trade, and we put out for the options. You see here 12 days, 20 days, bigger 30 days, what you maximum pay for it. And from that, we only went short in Boeing aircraft. Why? These two had a bad option chain. ConocoPhillips fell that fast that day that our price offer wasn't accepted. Yeah, so it fell below. But in Boeing aircraft, we are short, and it looks pretty good coming into their earnings. But that's not what we consider. We don't look at all these fundamentals. We see where institutions have a price move in or out, and here they were more disposing the asset, and so we just jumped on the bandwagon and we moved with the opportunity. Yeah? But you see here how it can all be spelled out by your system, having a clear idea of the maximum price to pay, the strike price you choose, the time to expiration. Yeah, never gonna let your option expire or take the exit at the expiration week if possible, except if you do, like, for example, spreads. We come to that shortly. Yeah, and now options trading strategy. Yeah, those are, for example, what do? You want to buy puts or calls, or you want to do a debit spread or a credit spread. Let me make that visible to you in a relation of the signal and the price. Yeah, if you have a stronger signal, yeah, here, or a weaker signal, if you have a fair price or a high price for the option. Yeah, so the system is going to tell you this. That will give the determination of what you do. On a strong signal and a fair price, puts or calls are super duper because they have a much higher return on the premium that you pay. When you have a strong signal but the price is iffy, then credit spreads are usually the methods to go in because you gain on a sideways motion or the motion in the direction you were assumed, or even you make a win when it goes slightly against you. Super. If you have a weaker signal but a fair price, you can do a credit or a debit spread depending of how you time your entries and what your system is telling you where the price move is going to go. In between those two, you'll always find an edge. And then we have the number 4. You have a weaker signal and a high option price. Usually it's no trade, but if you had to do a trade, then a credit spread would be the right one. But the last gray one, I'd recommend you to understand you don't have to trade because here the odds are not necessarily in your favor. Yeah? And so with that, let us summarize all those 7 variables that I showed you, which are system and which are knowledge based. And to see here, the price indication, your system needs to tell you. The max to pay, system needs to tell you based on the SPU measure. And the time to expiration, how strong is my signal? Does it carry out 5 or 10 bars? And so within that, plus the 1 week that I want to add, what do I want to do with that? And then it tells you 60% of your decisions for being an option trader are supposed to come from your system, and 40% come from your knowledge base. Neuro Street, I'm just letting you know I'm here. Okay, now there was no notice for me. Yeah. So here again, you need a strong system. That's again Facebook over the longer haul between 923 to just right now, and you see those crucial points that are highlighted where you have those SPY signals with a clear carry out. Where do and we want to trade on those key turning points. Yeah, success guideline is high probability trade setup, clearly spelled out entry, exit rules, multiple strategies. Don't just rely on one. Trade some from longer or shorter term, and know how to repair your trade to have an edge to go to the market. And bringing that to a more conclusion, have a written plan for it. Written is important, a financial plan. So what do I want to trade? From which sources shall my income derive from? Action plan, what are my favorable setups? How do I put them in motion? And only trade when those are on a chart. And here's an example where you see on the left-hand side, there's somebody who wanted to day trade some futures and then do some 4-hour trade with futures, have some stocks and options. That's the affinity of that trader. We'll make that plan individual to your circumstances and train you from the beginning to achieve the return that you want to achieve or better and moving ahead. Yeah. So we help you also with our systems to appraise situations. Yeah, so selling puts or calls, I just put that matrix on there. There might be an instance where you want to make that and you want to cover in potentially, so make a credit spread out of it, and also being highly productive. Our Never Lost Trading top line software has the market scanner, so you can scan for the opportunity. Also has watch list indicators that tell you in a duration of what is happening at several time frames side by side. And with that, we'll keep you engaged. If you want to be an investor, you want to have a return on investment, and you want to appraise your situation at best to do all this. And you can either do it from your system or you can subscribe to our alerts, yeah, the Never Lost Trading alerts. And with that, I give you an opportunity who is interested in that. We have an alert called Stock Alert. Yeah, that's just write me an email, first name, last name, but a legit email, not 123 trader, also a legit email, and I'll send you with no obligation. I need no credit card, nothing. For 1 week, the Never Lost Trading Stock Alert, and I send you a video of how to read it. It's Excel based, so that you can filter it down to your best ability of how you can work with it. Yeah, that's a nice free offer. Take it and see what the system can do for you. Yeah, because here you see, for example, for the spider, I just put an example out. 1 SPU, 2 SPU, added 2 SPU, price move 85% of the time, a retracement or reversal is expected prior to a potential continuation. If you know that, you have to take profit. Yeah, so that's what the system needs to generate for you. How far shall the price move reach? Where is the stop? How is my risk reward ability at that? To the upside, as I showed you, but here also to the downside. And here again, you see the pattern. What starts in a light tower likes to end in a light tower. Clear-cut price threshold, bang, taken out, and short we go. Yeah, the system will tell when to buy or sell. Those of you who are interested to work one-on-one with us, we set up all your charts. We do that work for you. The software will be server installed. The charts will be set up. You can change the charts afterwards to your specification, but first of all, we set them up for you. You get real-time data. We are based on Thinkorswim, yeah, and there you have very, very favorable opportunities to get the data without paying any fees. And you have then clear-cut entry, exit, stop on all the charts. You have position sizing models that we help you with, time in a trade, as I showed you, of 1 bar, 5 bar, 10 bars, risk handling, how much is my specific risk that I take for every trade and how do I put that in motion with the individual strategy and a business plan that we help you to write for your specific need and carry that forward. Yeah, so make an end to this where you have ambiguous moving averages or whatever to go left or right because they are low probability, or the MACDs. We tried them out many years back, but we couldn't get anywhere. So therefore, we put the 10,000 hours in to develop something that follows institutional money moves. Here's a double system. And with these institutional money moves, we carry forward multiple times in bits and bytes along the price move to the upside and to the downside, and will give you, regardless of what type of trader you are, a system for it. Here's a little idea for an entry-level system we call tradecolors.com. It's the basis for all that. So you trade when 2 of the same color bases are on the chart, and if the next candle takes out on the blue, set up the high, and on the red, set up the low. Yeah, and so that's how it looks in real. I just took an example here. So you saw here, boop, and we carried it to the upside. Whoops, and we carried it to the downside. And here you have again 2 red candles that are carried to the downside. The big advantage that we offer is, so that was a trade setup, that was a trade setup, and this one here. So in today's special, yes, for this system, we'll offer the box. It's an indicator that is part of top line, and we give that to trade colors because you see when the box lines break, they are midterm support, resistance, supply, demand lines. When they break, then price levels are going to move to the upside or to the downside or to the downside. And here on that candle in particular was no trade because the next candle didn't tick out the opportunity. Yeah? And so here let us erase this. So no, somehow it doesn't want to let me erase it. So yeah, so let me go there, erase all drawings. Yeah, and so here we also wrote recently last year a book. Yeah, integrated trading system. It's available at Amazon. It's a soft cover, so it's a real book, not just electronic, but it's available as an electronic book too. Little investment for getting the idea, notion of high probability trading, being as mechanical as possible, and putting things forward. Was drumming up? Okay. And so if you want to work with us, call us at 866-455-4520 or write an email to contact@neverlosstrading.com. What I showed you here was today top line. We'll give you a special offer on this one, yeah. But I don't want to put prices out here, yeah. On trade colors as well, and include the box line. The new book is like basically a $46 to $50 investment. Yeah, the stock alert you get for free for 1 week, and when you want to sign up for free books, articles, or go to neverlosstrading.com, there's a little box where you can sign up and be part of the community that we can inform you. I wasn't sure, Teddy, if I can read those questions because they somehow moved up. So if there are questions that I missed while I did this, do me a favor, you can raise them now. And as said, we are in business since 2008, actually. That's when the company was formed and quickly transformed over into working one-on-one with you. And the one-on-one has a big opportunity because, we can tune everything to your specific wants and needs. Why is that so important? The risk tolerance of person is different. Yeah, so some want to do a daily risk of this and this and be a day trader and participate in shorter term trades. We'll teach and we tune the system that I showed you to this, but also we'll tell you make a little money aside because if you only put everything on one card, trading just one instrument, what are you going to do if the instrument doesn't move for a while? So it's better to have multiple streams of income where you can have the opportunity to generate multiple ways what you want to trade for. And this is what we are here for also, to tell you, don't put everything just on one card. As a trader, it's beautiful to make some weekly income or longer term income as to make some short term income. And what I showed you here with option trading, the big opportunity today is you have a very limited risk that you need to put out or lay out for, because you saw on the example for Facebook, depending of $180, you are in one trade, and if you puzzle together, for example, a debit spread within covering a certain spread of expectation on the spool where the price is going to go, you'll be in for, let's say, a $2.50 spread, potentially with 60 cents only per share controlled. And you are making the difference of the spread, so you can make in that instance then $1.90. And these are all trades possible, but you need to learn, I can tell you here advanced, the debit spreads mostly release most of their premium that they give you in the week of expiration. So you might be sweating a little bit over it. They look easier to execute than they are, but you need somebody with knowledge telling you what instance, how to take those, and what's the price for an early out. Yeah, that's what we always do with our option traders. We define an early out, so at a certain point, or we define also a late action point. If your option spread is not where it's supposed to be, like for example at the week of expiration, what do? Do we do a calendar spread out of it, or do we do a hard close? How do things pan out? And this is what we offer you here with the Never Lost Trading System, something tuned to your individual wants and needs, where we can help you for every specific situation to work with that. And for example, when you work with us on top line, you have an assurance to work with us for at least 3 months, where we easily work yourselves through all the instances, or if you need help. So we're not letting you alone after we taught you how things are done, and we are teaching 20 hours to you of how the system can work best for the assets and for the time that you can and want to invest into trading. Yeah, the smaller configuration trade colors comes with 5 hours of trading, of training, and for 1 month of support. And in those months of support, you always get a report every day, an alert, but also on every weekend you get an alert telling you on a longer term view, yeah, weekly chart, this is what we see, which is following the system. And we look through the charts and make a proposal based on that and say, look, these are very high favorable setup under the condition that the price threshold which we formulate will be surpassed. And that puts you then in the opportunity that at that instance you can formulate a conditional order. Yeah, so you don't have to be in front of your computer when you execute things. And we work you, if that's an IRA, we find the trades that fits your IRA. Or we help you if you want to do option trading in there to reach the option level 3. Yeah, it's just filling out some paperwork, and then you can do risk limited option trades like debit or credit spreads in your IRA account. So we are in business for quite a while. As you see, we have had very many different people guiding them through, and you should see in our Christmas cards where people thank for making them independent, so they didn't have to move from Texas to North Carolina with their company, because they could stay where they wanted to be and with their loved ones instead of making that move by being independent through trading. Same from left to right, left coast to right coast. And so that is all possible. And that's what I'm here today for. And if you want to go and take my offer, I'll give you a personal consulting hour where we can go through the setups and see how these things can work for you and how you can put things in motion. But if in advance you want something more on the detail or you have questions, don't hesitate, send an email to contact@neverlosttrading.com. And with that said, I thank you very much for the attention. After or before the market opens, the alerts come out at between 3 a.m. and 4 a.m. Why that time? Because when we sent them out earlier, most likely the Google recipients, because it's a bigger package, you don't get them or they go in the spam box. So every day before around 3 a.m. to 4 a.m. So it gives you enough time, and I'm talking about Eastern time, for the alerts to go out. Yeah. With that said, I used up my time. Thank you, Teddy, for having me. I hope I could give you some insights for those of you in the attending today into the world of option trading, and I hope you take the opportunity. Good trading. Thank you very much. Bye-bye.